A common financial observation is the tendency for expenses to meet or exceed available income. This phenomenon is often examined through the lens of behavioral economics and personal finance principles. One of the primary concepts used to describe this is Parkinson's law, which, when applied to finance, suggests that expenses will rise to meet income. As an individual's earnings increase, their expenditures often increase proportionally rather than their savings rate. This can be seen when a pay raise is quickly absorbed by new recurring costs, such as a more expensive car payment, a larger home, or more frequent discretionary spending. Consequently, the feeling of financial pressure may remain unchanged despite a higher income. Another contributing factor is known as lifestyle inflation or lifestyle creep. This is the gradual increase in spending on non-essential items as one's income grows. What were once considered luxuries can become perceived as necessities. For example, dining out, which might have been a rare treat on a lower income, can become a weekly or even daily habit. Similarly, brand preferences may shift towards more expensive options, and travel habits might evolve from budget trips to more luxurious vacations. This incremental expansion of spending habits often happens subconsciously, making it difficult to track without diligent financial awareness and record keeping. The result is that a higher income does not necessarily translate into a higher net worth or greater financial security, as the additional funds are consumed by an elevated standard of living. Psychological factors also play a significant role. Social comparison, often amplified by social media and advertising, can create pressure to keep up with the Joneses. Observing the consumption patterns of peers, colleagues, or online influencers can lead to spending that is driven by a desire for social conformity rather than genuine need or utility. This external pressure can lead individuals to make financial commitments that strain their budgets, such as purchasing homes or cars that are beyond their practical means. The perceived social status associated with certain goods and services can make them seem like essential expenditures, even when they are not. This is a powerful force that can systematically push expenses upward in alignment with any increase in income. The structure of modern consumer credit also facilitates the expansion of expenses. The widespread availability of credit cards, personal loans, and, by now, pay later services makes it easier than ever to spend beyond one's immediate cash flow. While these tools can be useful for managing liquidity, they also lower the immediate barrier to making a purchase. The psychological distance from spending actual cash is greater when using a credit card. This can lead to less mindful spending and the accumulation of debt. Interest payments on this debt then become another fixed expense, further reducing the discretionary income available and tightening the budget. In this way, the very tools designed to provide financial flexibility can inadvertently contribute to a cycle where expenses perpetually chase income. Furthermore, there is a natural progression of life events that brings new financial responsibilities. Events such as moving out, getting married, having children, or buying a home all come with significant and often ongoing costs. For instance, the expenses associated with raising a child, from childcare to education, represent a substantial long-term financial commitment. As individuals progress through these life stages, their baseline cost of living naturally increases. While income may also increase during this time to accommodate these changes, the new expenses can easily consume any additional earnings. These are not necessarily instances of lifestyle inflation in the discretionary sense, but rather fundamental shifts in financial obligations that reshape an individual's entire budgetary landscape. Inflation is an external economic factor that systematically increases the cost of living over time. Even if an individual's income and spending habits remain static, the purchasing power of their money decreases. A salary that felt comfortable 5 years ago may feel tight today simply because the cost of goods and services like groceries, fuel, housing, and healthcare has risen. If income does not increase at a rate that outpaces inflation, an individual's real income effectively declines. This means they must spend more money just to maintain the same standard of living. For many, wage growth lags behind the rate of inflation, creating a persistent financial squeeze where expenses seem to grow on their own, independent of any changes in consumption behavior. This macroeconomic pressure is a constant force that works to expand the expense side of the financial ledger. The concept of mental accounting also offers an explanation. This is a cognitive bias where people tend to separate their money into different mental accounts based on its source or intended use. For example, a year-end bonus might be mentally categorized as windfall money and earmarked for discretionary spending, rather than being integrated into the overall budget for saving or debt reduction. Similarly, a salary increase might be viewed as extra money available for new, recurring expenses, rather than a resource to bolster financial reserves. This compartmentalization can lead to less optimal financial decisions, as it prevents a holistic view of one's finances. By treating different sources of income differently, individuals may inadvertently direct new funds toward consumption instead of using them to improve their overall financial position. Finally, a lack of detailed financial planning and budgeting is a common reason why expenses rise with income. Without a clear plan that outlines financial goals and allocates specific amounts for saving, investing, and spending, money tends to be spent as it comes in. A budget serves as a financial roadmap, providing a framework for making conscious spending decisions. In its absence, spending is often reactive and impulsive. An increase in income without a corresponding adjustment to a formal financial plan simply means there is more unallocated money available to be spent. The path of least resistance for this unallocated money is often consumption. Therefore, the simple act of tracking income and expenses and creating a deliberate plan for How money will be used is a foundational element in managing the relationship between the two. The absence of such a structure allows expenses to expand without constraint, naturally filling the space created by any additional income.